Hello, welcome back everyone. In this video, we'll continue with chapter 5 and we're going to go over how to compute the rate of return using spreadsheets. Let's get started. First, let's take a look at what is the interest rate. Financial terms can sometimes be confusing. You may have seen the term APY or annual percentage yield being used. This is the interest rate that takes into account compounding. Versus APR or annual percentage rate. APR is interest rate that includes fees but does not take into account compounding. Let's take a look at an example. Let's say if fee is $0, then credit card balance is due each month. This means monthly compounding. A 24% APR with monthly compounding is equivalent to a 26.82 APY. We'll go over this calculation in a minute. Most importantly is understand the difference between the two. You'll notice that financial institutions typically advertise APY, annual percentage yield on savings, and APR on loan products. Pause for a minute and think about why they would do that. Obviously, it's because APY shows you a higher number than APR. So when they want you to save money with them, they show you a higher rate. And if they want you to borrow money from them, they show you a lower rate. So how are the two interest rates related to each other? To answer that question, we're going to take a look at how APY, annual percentage yield, is computed. The most important part of compounding is the fact that you can earn interest on interest. And interest is based on the beginning balance of each period, not just the original amount. Sometimes APR is referred to as the effective annual rate. You may hear this term in other economics or finance classes. Let's look at an example with $100,000 at 8% APR. This is annual percentage rate. If there's no compounding, the total interest will be $100,000 times 8%, $8,000 in 1 year. With quarterly compounding, you'll be higher. Let's see how does it work. So let's say this is a quarterly compounding, which means 4 times per year. If it's 8% per year, 8% divided by 4 will be 2% per quarter. So in the first quarter, $100,000 times 2% will give you $2,000. And at the end of that quarter, that $2,000 will be added to the balance. So it becomes $102,000. The interest for the second quarter will be 2% of this. So it'll be $102,000 times 0.02, 2%. That's $2,040. Once again, that will be added to the ending balance, and that increased to $104,040. Pause the video a minute to make sure you understand this calculation. The same thing goes on in the next quarter. The interest for the next quarter, quarter 3, is $104,040 times 0.02. That gives you $2,080.80. This continues until the end of 4 quarters. And if you add up the interest in the 4 quarters, you have $8,243.32. So that's the interest in 1 year with compounding. The interest in 1 year without compounding is only $8,000. So this is higher. So in fact, with quarterly compounding, the interest is $82.43. If you divide that by the $100,000 that we started with, it's 8.24%. And that is your APY. There's a simple way or a shortcut to compute APY. You can use this formula. So you take 1 plus the APR divided by M. M is the compounding frequency. APR is the annual rate. M is the compounding frequency per year. If it's monthly compounding, it'll be 12. If it's quarterly compounding, it'll be 4 because there are 4 quarters per year. You can also use the spreadsheet template that we have created. So go to the EAR tab. So the time unit, in our last example, it was quarterly, so it will be a quarter. So that means it's 4 times per year. And the interest rate we were working with was 8%. And you turn out to be a EAR of 8.24%, the same as what we have computed. So go ahead and try different numbers to see the difference between APR and APY. Earlier, we said that APR includes fee. So what is APR? APR is actually a very special number. There are financial regulations that dictate how APR is computed, and financial institutions must disclose the APR before any loan agreement is signed. The purpose of the APR is to provide a consistent basis for borrowers and consumers so that they can compare different loan products. Be mindful that not all the costs and fees are required to be included in the calculation of APR. The moment that the law makes a fee mandatory to be included in APR, financial institutions find a new way to come up with new service fees that is not required by law to be incorporated. The technical definition of APR is that you take all fees and interest into account divided by the principal amount. This is the amount that you borrow. So this is the total interest paid over the life of the loan. Principal is the loan amount, and N is the number of days in the loan term. So this is pretty easy to do for a loan that is very short term, but this can get complicated when it's a 30-year loan or a 5-year loan. The Federal Reserve actually created a table for financial institutions to use. Here's a link to the Consumer Financial Protection Bureau for more information about how APR table come around. Oftentimes, the rate of return on a loan or on an investment is not obvious or is not clearly stated by the provider. The good news is that as long as you have all the cash flow, you can figure out the actual rate yourself. This is a very important tool in personal finance. In this example, we're going to take a look at payday loans. Payday loans are not regulated, and the way they state their interest is very tricky. Instead of calling what they charge interest, they call them fees, and therefore subject to different regulations. They are looking at, Sam is looking at borrowing $1,000. The term of the loan says that they will charge Sam a $150 fee. The payday loan company will deduct $1,150, which is the $1,000 plus the $150 fee from Sam's paycheck in 2 weeks. So how much is this loan really costing Sam? So the $1,000 is the present value. This is how much Sam will get today. The $1,150, this is the future value because this is how much Sam will have to pay back. And the time horizon is 2 weeks. We'll use the rate function. The number up here is 1, so it's just one time. So remember, interest is computed at the end of each time period, so it's computed once. There's no additional interest. It's just $150 at the end of 2 weeks. So the compounding frequency in here is bi-monthly or twice per month, so every 2 weeks, and it's actually 26 times per year. The payment amount, this annuity payment, is 0. You just have two numbers, present value and future value. Sam's going to receive the $1,000 today, so that's positive. Sam will have to pay back $1,150, so that's negative. Since there's no annuity, we'll leave that blank. You'll use the rate function. We start with the equal sign, equal rate. Pause and try it out on your own. Did you get 0.15? So that means 15%. That doesn't sound too bad, right? It is 15% every 2 weeks though. So it's 15% every 2 weeks. And there are 26 payroll periods per year. 15% times 26 is 390% per year. And this is assuming that the loan is fully paid off in 2 weeks. Otherwise, there will be additional fee to this loan. Fees can be very sneaky. In fact, this is a problem going all the way back in the 1950s. So the federal government has, there are certain regulations to make sure that lenders disclose fees to borrowers. And this is where the term APR, you may have heard of the term APR, it stands for annual percentage rate. But the APR that is required by law to be disclosed should include fees and total interest. And this is the formula that the federal government used to compute APR. Let's take a look at how it works. Sam looked at the payday loan and realized that, wow, that's a lot of money. So he did some more research, and they found a lender who is willing to loan them a 90-day loan at 20% per year plus a $50 fee. For loans that are less than 1 year, this formula works quite well. So let's first take a look at how much interest Sam would be paying. It's $1,000 times 20%, so that's 0.2. There are 90 days in the loan, so the 20% is per year. So we divide that by 365 days times, that will give you the interest per day, and then times 90 days. So the interest is $49. But there is a $50 fee. So the total fee is $50 plus interest is $49 divided by the $1,000 that Sam borrowed, divided by the number of days in the loan, so that's 90, times 365 days in a year, and you get 40.15%. So this is what the lender, a regulated lender, will have to disclose as the APR. So it is not 20%. So before the legislation was passed, the lender can say the interest rate on this loan is 20%. Now the law requires that they have to disclose something called an APR, and they have to say that the APR is 40.15%. This law makes loan much more transparent, and it's easier for consumers to compare loan offers and also not be trapped into too much debt. Now let's take a look at yet another lender that Sam finds. He saw the $50 loan fee and realized, wow, that's a lot of money. And they do some more research, and they find someone online that says, we don't charge fees. We offer you a $1,000 loan at 20% per year. But they have to pay it back at $100 each over 12 months. So this is how they figure it out. They say the finance charge is 20%. So 20% times $1,000 is $200. So what they determine is you borrow $1,000, interest is $200, so that's $1,200 altogether. You have to pay it back over 1 year, so 12 payments divided by 12 is $100 each month. That sounds reasonable, but what is the true cost of this loan? You probably guessed that the true cost is not 20%. Now that you have learned how to use the time value of money tool, you can solve this mystery for Sam. Essentially, Sam got $1,000 today, so that is the present value. He have to pay back $100 each month, so that is the payment. So this is the monthly payment. You have to make 12 payments. The number of periods is 12. The payment amount is $100 per month. We'll make that negative. That's money that they have to pay out. Present value is $1,000. That's the value of the loan. Future value is 0 because they will fully pay off the loan. And we can use the rate function that we saw earlier to compute this problem. Remember, this is monthly payment. It's $100 per month. So the answer, 2.92%, is the interest rate per month. If you multiply that by 12 months per year, you'll get 35% per year. The cost of this loan is not 20%. The cost of this loan is closer to 35%. The government has a loan table that you can look up. The APR for this loan, according to the government table, is 35%, very close to our own calculation. Before the pass of the Truth in Lending Act, we talk about this in the textbook. Before the pass of this law, loan company or banks can advertise the loan as 20% and hide the fee or hide the fact that it's $100 per month payment. When the truth is that the APR for both loans is not 20%. In this case, the loan is actually higher than 20% is because Sam had been paying off the balance each month. Every time they make a $100 payment, the balance goes down. It's no longer $1,000. The bank was computed the original loan at 20% at $1,000, not taking into account the pay down in principal that Sam has been making all along. When you take that into account, the true cost of borrowing is 35%. Interest rates obviously have a huge impact on both your financial planning from an investment point of view and also from a borrowing point of view. Let's take a deeper look at what makes up interest rate. You can look at all interest rate as having two components. There's a risk-free component. This will be the interest rate that charged on something that has no risk at all. And then on top of it, if there are any risks involved, there will be additional costs, and we call that risk premium. You can think of interest rate as having two components, the risk-free component and the risky component. The risk-free component, the one that has no risk, really doesn't exist because the world is full of uncertainty. The truth, in real life, we oftentimes use a 3-month treasury bill as a proxy for the risk-free rate. Factors that affect this rate include inflation, supply and demand of money. This is the action by the Federal Reserve, and also economic condition. So when the economy is growing strong, there will be high demand for money and interest rate will be higher. And if inflation is high, that will also increase interest rate. So in a low inflation, low demand for money, slow growth, you'll have a lower interest rate. In a strong economy with inflation, you'll have a higher interest rate. And this affects the risk-free rate. And then there's the risk premium components. Factors that affect the risk premium include, in general, how worried people are about risk. So if everybody in here we got market, this is the financial market. If consumers and investors and businesses are all feeling unnerved, that means their risk averseness is high, they'll demand a higher risk premium. So when people have high confidence, they'll demand a lower risk premium. So when confidence is low among consumers and businesses, interest rate will be higher. The next is the individual's risk. If you have a high default risk, then you will have to pay a higher interest rate. And now that has to do with how long the money is locked in. The longer term, so a 30-year loan will have a higher interest rate than a short-term loan. And the last is liquidity. Liquidity refers to how easy it is to sell something off for cash without driving down the value. So the more liquid a financial instrument is, the lower the liquidity risk. And then lastly is tax. That is because income on some securities are taxed differently. We're going to talk about personal tax in the next chapter. To summarize, generally there is a positive relationship between risk and interest rate. What that means is higher risk will result in higher interest rate. This rule applies to both investment and loans. That means if you invest in a high risk security, you can expect to get a high return. The corollary means that if you get a high return on an investment, it is a high risk investment. If you are the borrower and you have a high default risk, Usually this is based on your credit scores, another topic that we will talk about in the future chapter. Banks will charge you a higher interest rate. Another way to classify interest rate is based on whether they are fixed or if they are variable or floating. Fixed rates means that the interest rate will remain constant throughout the horizon of the investment or the loan. Examples of fixed rate investment include certificate of deposits, fixed rate loan. The most common type are fixed rate mortgage or fixed rate auto loans. Variable rate or floating rate are interest rates that are tied to a benchmark. The most common examples are credit cards, adjustable rate or mortgage, and investments. In fact, most investments are variable because the return on a mutual fund or return on most equity, meaning stocks or mutual fund investment, change every single month. Many variable products are tied to the prime rate. The prime rate is the best interest rate that a bank charges its most valuable customers. So for example, credit card interest rate may be 20% plus prime. That means whatever the prime rate is, you pay 20% more than that. So the prime rate is the lowest interest rate the largest bank charge their best customers. In conclusion, there is no free lunch in finance or economics. So beware of investment that promise a lot of return with low risk. Investment that have high return typically have very high risk. You may hear that, oh, the stock market is not efficient. This may be a topic of debate in the academic circle, but in real life, financial market is very competitive. The truth is that investors that have the least wealth or limited wealth and income are the least suited to take on high risk, even though the high return may be very attractive. We will talk about different investment options in a later chapter. The next video is going to be optional, but I strongly encourage you to watch it. In the next video, I'll go over how you can use a pre-made template to compute time value of money problems. There's a link in the slide that provides you access to the template, and you can follow along in the next video and learn how to use the template. I'll see you soon.